This conference will now be recorded.
So what is initial margin? Initial margin is the amount of cash that you must deposit in the account to start trading. Okay, so basically this is the amount you need to buy one future contract. Okay, and normally the initial margin is set by the exchange, okay, as per the regulatory compliances. And you need to have initial margin to buy one lot. And maintenance margin is the basically a margin level you need to maintain to carry on the trade, because the price changes on a daily basis, or in fact it changes every second. There are chances that when you buy the contract, after that the price may fall, and you may incur losses, and losses could be more than your initial margin. So let's suppose you deposited 10% as initial margin and the price drops to 12%. So your account balance will be minus 2%. So that is a situation where one party can default. They can deny that we don't have extra amount, I can't give you. So exchange cannot give, from their own pocket. So what exchange does is, what they do is, they set up a maintenance margin level where they want to ensure that the buyer or seller must not have losses beyond the maintenance margin level. So if the losses are beyond the maintenance margin level, it is more than the maintenance margin level, they give you a margin call. So for example, if 10% is the initial margin and around 7% is the maintenance margin. So if you have a loss of 3% or more than 3%, your account hits the maintenance margin level. Now in that situation, you get a margin call. Okay, and when you get a margin call, you have to deposit the variation margin. Now variation margin is basically the difference between the initial margin requirement and the current cash or current balance in your account. So let's say you are left with 7%, you have a loss of 3%. Now you have to top it up, you have to top up till the up to the 10% mark. So you need to bring 3% more. So whatever you lost, you have to bring in back to the initial margin level. Now this concept you will understand using an Excel model, or you can say Excel template. So let's open the Excel template and understand the concept of maintenance margin and marking to market and maintenance margin. So marking to market and maintenance margin, both concepts we will discuss right now. So let's suppose there is a company named Idea Cellular, and we have a share listed on National Stock Exchange. On 1st January, the price is around 81.90, and the lot size or the contract size, you can say, is around 7,000. So the total value comes to around 573,300, okay, which is basically lot size multiplied by the price. And the initial margin requirement is around 13%. So 13% of the total value. So that comes to 74,529. So you need to deposit around 74,529 in order to secure one contract, in order to buy one contract. So let's suppose you have only this much and you purchased one contract and your account balance is nil, it is zero. Now, luckily on 2nd January, the price increased to 72.9, 72.9 rupee per share. And the lot size around 7,000, so total value again increased to 580,300. And the initial margin requirement on the 2nd January is 75,439. So a new buyer must have to pay 75,439, but the the old buyers, so somebody who purchased yesterday, they don't have to pay again 75,000, but yes, they have to pay the increased amount. So the increased amount right now here is around 910 rupees. So that you have to pay on a daily basis. So I don't have an account balance of anything. So how do I pay the difference of around 910? So basically what happens on the second day is the price increased by 1 rupee. So you made a profit of around 7,000. So 1 rupee per share and you had a contract size of 7,000. So you made a profit of 7,000. So your today's 2nd January's marking to market was around 7,000 M2M, that is called marking to market, is around 7,000, out of which the exchange deducts 910 rupee and credits into your account with exchange. And so your deposit with the exchange increases from 74,529 to 75,439, and remaining 6,090 they credit in your account balance, your trading account balance. Okay, so this thing is what something, if you want to withdraw, this is your equity. If you want to equity fund, basically, if you want to withdraw this cash, you can withdraw. Otherwise, you can keep it in your account. On 3rd January, the price increases to 83 rupees and 90 paisa, and the lot size is around 7,000. So the value again increases. So now the initial margin requirement is again increasing. So you need to bring in 910 again. So you again have a profit of 7,000. So around that is a marking to market. 910 is deducted from this and remaining balance is credited into your account. Now on 4th January, luckily what happened is the price again reduced 2 rupees. So it is now back to the initial price of 81.90. You have a loss of 2 rupees per share, so total loss is around 14,000. So the total value also reduces. Now in this case, the initial margin requirement also reduces. However, you have a 14,000 loss. So what exchange does it, or your broker, what they do is like they will reduce this amount from your account balance. So that is done automatically, basically, and you are not bothered at all. So they simply reduce it from your account. However, after reducing 14,000 from your account, which was actually which had a balance of around 12,180, you are still your account balance is in negative state. So around 1,820 rupees is short. So what they do is they reduce this loss from your security deposit, so your margin deposit. So your margin deposit with the exchange was 73,349. So initially you purchased at 74,529. Again you paid 910. Again you paid 910. So your total deposit was 76,349. So out of this, 1,820 is reduced. So you are left with 74,529. Now look at this. This number and this number on 1st January and the 4th January initial margins are same because the prices are same. So if the idea is this, if profit is made, it is credited, and if the loss is made, it is debited from your account on a daily basis. So that is called a marking to market process. Now what happens on 5th January, you again see a decline in price of 1 rupee. So you again have a loss of 7,000. Now, so when you have a 7,000 loss, the margin balance in an account reduces to 67,529. But actual requirement is 73,619. Now, exchange does not immediately tell you in case of price going down to credit the difference, but initially basically they set up a maintenance margin level. So let's suppose maintenance margin level is 0.09. Okay, so you need to have around 50,926 as your account balance. Till then you don't get a margin, call. So current balance is around 67,529. and your maintenance margin level is 59,967. So this is basically 9% of the total value. So if your account balance falls below the maintenance margin requirement, then you get a margin call. So this day you get a loss of 7,000. Your account balance reduces. The next day again the price goes down. You again have a loss of 7,000. The price goes, your account balance goes down. And look at here, the requirements also changes to buy one contract. So initial margin also reduces every day because the total value is also reducing. So on 7 January also, you again had a loss of 1 rupee 7,000 in total. So now your account balance is 53,529. And on 8 January, okay, the price goes to around, it goes 42 paisa down around. So you had a loss of around 4,200. So it went something around, not too much loss, but there was a loss of around 60 paisa. I'm so sorry. So you had a loss of 4,200. But after deducting this 4,200 from 53,529, you see that the account balance or margin deposit with the exchange is same as the maintenance margin requirement. So basically you need to maintain this much. So in this situation where the margin account balance with the exchange and the required maintenance margin level is hit, both are equal, or it is below the account balance, margin balance with the exchanges, below the maintenance margin level, in both the cases, you get a margin call. So how do you receive a margin call? Either your broker, stockbroker, can give you a telephonic call, or can send you an SMS or an email. So they will communicate with you, okay, through software. There is a pop-up in software, trading software, and they will intimate you that your balance is now lesser than the required maintenance margin level. Now you have to top it up to the variation, initial margin level. So you have to top up your account. So you have to deposit more money to bring it back to the initial margin level. So initial margin level, they will not ask you to bring it till 74,000. They will ask you to bring it, till this level, around the current initial margin requirement level. So the variation margin is basically the difference between current initial margin and the current account balance. So if you see the difference, that comes to around, you can see the difference comes to around 21,924. So you have to put this money back. Now, what happens if you fail to deposit the variation margin? So what broker will do is, see, the broker has the right on your account. So what they do is they will sell off the contract and return you the remaining amount. So let's say if they are able to sell the contract at 78.3, then they will return you around 49,329 because all the losses are already deducted. However, when they place the order to close your contract, and suppose the contract got settled at 10 paisa down further, so it is 78.20. So you incurred some extra losses. So that losses will also be deducted. So the remaining amount will be credited into your account. So the idea is this: if you deny that we don't have money, the variation margin, your position will be squared off. That means you have purchased, the position will be sold off, the broker will sell it off, and at whatever price it got sold, after deducting your losses and all, brokerage and taxes, they will return you remaining amount. Give me a second.
This conference will now be recorded.
I'm back. Let's resume the session. Yeah, so we understood what is variation margin. Now this is the price level at which we get a margin call, that is 78.3. Now remember, when you are trading in futures contract or you're hedging your position using future contracts, you should know that at what level, at what price level you will get a margin call, because this will help you in managing your cash position, because the time they give you a call and you don't have enough money, quite possible your position will be scared off and you may have unsolicited losses. So you must determine the price level at which you get a margin call at the time of initiating the contract. So we understood this thing using a hit and trial method, or you can see a step-by-step method where we started reducing 1 rupee on a daily basis. And we figured out at this level we get the margin call. Otherwise, there's a very simple formula for this. We have a formula that is called 1 minus initial margin divided by 1 margin minus maintenance margin multiplied by initial purchase price. Okay, so if you apply this formula, you get the number, the price immediately. So let's apply this formula to this thing which we did. So we have 1 minus initial margin, initial margin, that is around 13%, and that is divided by 1 minus maintenance margin, that is around 0.9. Anji? Yeah, so 0.09, and then you simply multiply it with the purchase price. So I need to put a bracket extra here and then multiply it with the initial purchase price. So this is the initial purchase price. So I get 78.3. Exactly the same number here, both are same. So I get exactly the same number. So at 78.3, I'll get a margin call. So you must remember this formula, you have to note it down. We may have questions on this thing. Now, so as we understood about the maintenance margin and the initial margin concept, normally the initial margin is set by the exchange, and some of the brokers apply some haircut on the initial margin. So haircut is basically they increase the initial margin. So exchange may have a initial margin requirement of 10%, the broker may ask you for 12%. So it may differ from person to person, quite possible. sorry, broker to broker. It may differ from broker to broker. So one broker may ask you a little lesser margin, another broker may ask you a little more margin. But they cannot go below the initial margin requirements set by the exchange. They can go higher. Now, the maintenance margin also set by normally the broker, and which is not set by the exchange in most of the cases. And they have their RMS risk management team or system in place where they give the call to the clients if the margin balance falls below the maintenance margin balance. The initial margin balance falls below the maintenance margin balance. Now, let's understand the concept of open interest and all. So what is open interest? We understood what is leverage. Now the contracts are normally settled in four ways. One is like close out, offset at the expiration. So what do you mean by this? So if a trader holds a long position, they can short the same contract with regard to the term of the original trade and vice versa for the short position trader. So offset at the expiration. So that means you have purchased one contract, you have bought one contract, you will sell the same contract and your position is offsetted. So your position is closed. And the difference between the prices will be your profit that is credited in your account. The second way to settle is like this requires a long trader to accept delivery of die underlying asset. What die? Delivery of the underlying asset. Okay, and pay the short position the settlement price for the previous day. So in this thing, basically, you are accepting the delivery of the underlying asset. So which means you mark the exchange that I want the full delivery of the asset. So let's say you are a commodity trader and you have purchased, let's say, uh, maize on commodity exchange. You can ask the exchange to deliver the maize, physical in physical format to you. Or if you are trading an equity market, you can ask the exchange to deliver the shares in your demat account. So when you ask for the delivery, the exchange will ask you to pay the full amount. Why? Because when you initiated the contract, you hardly paid 10-12%. So you have to pay the full amount if you want the delivery, and your contract will be settled. And then we have equivalent cash settlement. So when the contract expires, the margin account is marked to market and gain is posted in your account. So quite possible you forget to offset your account. Okay, so remember, you forget to offset your account. So you purchase an account, contract, and you forget to sell it on the date of expiry. So you are not offsetting. So you are buying, you are selling, you are offsetting your contract. So quite possible I have purchased a contract and 31st January is expiry. I was not able to close my position by offsetting. So I leave the contract, just leave it. So what exchange does is they will settle the account on their own. So they will mark to market the account on that day. If there is a profit, they will gain post in your account. Otherwise, there's a loss, they will deduct and they'll close your account. So don't worry, even if you don't offset your account, the exchange will offset it for you. So they will settle it, the contract. So that is called equivalent cash settlement. This is the third way this happens. So if you forget, exchange will do it for you. But you should do it. Otherwise, when you exchange does the settlement, normally it is at the higher price and you have more losses. And quite possible there might be some penalty imposed also. So you should close your position yourself. Don't leave it to the exchange. And the fourth point is exchange for physical. So exchange for physical means here the long and short holders arrange alternative delivery procedure. For example, if the exchange requires the physical delivery of the asset. So which means here you are buying, taking delivery, and quite possible exchange says that you need to deliver to close your position. So you have positions in a stock, the underlying asset as an inventory with you, you can deliver that and close the contract. So there are normally 4 ways through which you can close the or offset the contract. Okay. Any doubts till now? No, I suppose. So let's move on further. Now, what is open interest and how it is different than trading volume? Now, volume is total number of trades happened in a period of time. Let's say one day. And open interest, basically total number of contracts formed between buyers and sellers since launch of the contract. So let's understand what's the difference here. So volume is basically number of trades. So you buy, I sell, that is a trade, but that also creates an open interest. That's how it is different. So let's understand this by taking an example. Now, so there is, let's suppose on 1st of January, there's a buyer. His name is A. Don't keep your kid's name A, B, C. Let's suppose the buyer's name is A and the price is around 50,000 for 1 kg of silver, let's suppose. So you're buying a commodity contract and there is a buyer B or seller B is interested in selling the contract. So he's writing and there's a guy A is buying. So both together get into a contract where B will deliver the silver on the 6th of January. Let's suppose 6th of January is the delivery date or the expiry date, and A says, okay, I'll buy. So they can settle the contract in cash and they can settle the contract by delivery. So both together create a contract. So our open interest is 1. So this is the number of contracts since launch of the since the launch of the contract. So open interest is 1, and because there's one trade, so volume is 1. And volume, remember, is for one day only. So that is not carried for the next day. On 2nd January, there's a buyer C and there's a seller D. So the price is around 51,000, price increases. So the open interest here is around 2 because there is one trade and there is new contract opened between C and D. So there is 2 open interest, 1 from yesterday and today's one, both together makes 2. And the volume is still 1. On 3rd January, there is a buyer EF. So there are 2 buyers EF. There are 2 sellers GH, and both together make 2 trades. So we have 2 trading volumes, but open interest goes to 4. Why? Because we have 2 from today and 2 from yesterday. So we have 4 total contract as on 3rd January. On 4th January, we have buyer B. Now, if you notice, B was previously a seller. Now he is buying. So basically he is closing his contract by offsetting. So he purchased, sold before, and now he is buying. So it's offsetting contract. So his position is booked. Now look at that. B is having a loss of around how much? 3,000. So B is having a loss of around 3,000. And so he is having a loss of 3,000. And he is a new seller. So he is actually selling that contract. So basically B is transferring B is transferring his contract to I. So there is no new contract made. So basically one contract is closed and another contract is opened, you can say, or the previous contract is being transferred. So in this situation, there is no new contract being created. So we have open interest same because there's no new contract, but still we have a volume. Now we are discussing the mechanics of future market from financial market and products. Okay, and last session we understood about the futures, and we are carrying on those things in today's session also. I have already posted a video on this previously, so those guys who missed, kindly go through the video of last session. So we have on 5th January, there is a buyer D. So he was basically an old seller. So he's offsetting his contract. So he's exiting now. He is also having a loss of 3,000. And A was an old buyer. So he is now selling. He's also offsetting his contract, but he is making a profit of 4K. Right. So we have an open interest here reduced to 3, but still we have a volume of 1. So why open interest reduced? Because D is closing his position and A is closing his position. They're offsetting. So like you need 2 people to create 1 contract, you need 2 existing positions, okay, which are being offsetted against each other to close 1 contract. So open interest reduced to 3. Still we have a volume. So volume relates to only number of trades. And open interest will actually give you the liquidity condition in the market. How much money is being poured in, how much liquid is involved, how much cash is involved. On 6th January, as we discussed, it was the expiry date. So all contract must settle. So you settle it on your own or the exchange settle it for you. So if the exchange settle it for you, remember they will mark to market it and they will also impose some penalty. So better you should offset. On 4th January, we have a trade. We have a trade between B and I. B said I want to sell, sorry, buy, and I said I want to sell. So both together did a trade. So there is a trading volume 1. If they didn't do a trade, there will be no trading volume. Okay. However, the open interest remained unchanged. Why? Because B simply transferred his contract to I. So I took over B's contract. So there was no new contract created. Right? So on 6th January, we have GHI and CEF. All are closing their positions. They're offsetting their trades. Nobody is asking for delivery. So how the cash will be settled? G and H, they sold at 52,000. Now the price increased. Now look at here. So how much? It increased to 55,000. So these guys will also have a loss of 3,000 each. So what I do is I'll put a minus sign here. So B lost 3,000, D lost 3,000. Why B lost? Because B sold at 50,000, price increased to 53,000. So B was a short seller. Price if increases, it incurs loss to him. D also sold at 51,000, price increased, it will incur a loss of 3,000. GH sold at 52,000, price went to 55,000. Both together incurred a loss of 6,000, so 3,000 each. Right? And I, this guy sold at 53,000, price went to 55, so he incurred a loss of around 2,000. Right? So here total comes to around 6 and 6, 12 and 2, 14,000 around. Right? So these guys lost 14,000. Now look at A. A made 4,000 profit. Why? He purchased at 5,000, sold at 54,000. So 4,000 this guy got. C got 4,051 to 55. And E and F, these guys purchased at 52,000 and the price went to 55. So both together make 6,000, 3,000 each. So this comes to around 14,000. So all the buyers made profit because the price increased. And look at here, one person's gain is another person's loss. So it's a zero-sum game. In the stock market, if you're making money and enjoying parties, well, somebody is mourning and you are happy, somebody's sad. So if you are a kind-hearted person and if you feel others' pain too much, then don't trade in stock market. And if you're a very practical guy, don't take it otherwise. Just remember the Darwin's law, survival of the fittest. Keep that in mind. All the people who are making profit in this market, they deserve to make profit because they are working very hard to understand the market and invest their money. Guys who are normally not making any decisions in life, not analyzing, lazy by nature, not studying, and they are treating it like gambling, they are most of the time losers. So if they are losing, you should not have sympathy with these guys. So focus on your trade, and if you're winning, that's your reward. Don't worry, never worry about people who are losing in the market. So in future contract, one wins, another loses. So hopefully you understand, open interest is simply the number of contracts open between buyers and sellers, and volume is total number of trades every day. Now, let's understand the uses of future contract. Normally it is used for three purposes: speculative trading, so where you purchase a contract, you keep it, and you believe in future the price will increase and you will sell it and make some profit. Or you short the position, you believe that in market and in future the price will go down and you will make profit from price fall. Hedging is used for normally risk management. We will understand what is hedging using a future contract. And arbitrage is normally to generate riskless profit from mispricing in the market between two contracts. Right. Now, let's understand about the hedging thing in the markets, the futures contract for hedging purposes. So hedging strategies using future contracts. So let's move on to another aim statement. So understand about hedging strategies using future contract. So we have two types of normally hedge. We have a long hedge and we have a short hedge. So what is a long hedge and what is a short hedge? Very simple. When you are into a long position, you short sell your position or you hedge your situation, position. And you are already into a short position, okay, and you long your position and hedge your contract, your trade. So this is about short hedge and long hedge. So let's discuss about how we do that. To understand hedging, let's open a blank Excel spreadsheet. Now, in how many types we can do the hedging? See, it depends on what kind of position we are. So we could have a stock position, we could have an index position, we can have a commodity position, we can have a currency position, we could be an exporter, importer, we could be a currency trader, we could be a bank. So whatever financial instrument I have taken and which is volatile, okay, the prices are volatile of that contract, we can hedge the volatility, risk arising from the volatility. So we'll understand hedging for majorly three things. One is for commodities, one is for stocks, and for currency, and yes, for interest rates also, basically the bonds. Okay, so we will use hedging for all those things. First of all, we have to understand basic concept of what is hedging and how it can help in limiting the risk in the market. Okay, so let me quickly go through the slides. Normally, I don't go word by word as per the uh, book. I must understand the context of the book and then I take the classes in my own way. Fine. Because text you can read easily, understand the concept. So, what is hedging? So, simple equity hedge or stock hedging. Hedging stocks. So, let's suppose we have a share, we have TCS, right now TCS shares, and the QTY, basically the quantity is around 250 and the price is around 1800 per share. So the total value comes to around this into this. So this is on 1st of January, let's suppose. So this is what position I have. Now, after some time, I believe that the prices may fall. And I need to hedge my position. So when did I realize this? So let's suppose on 10th of January, the price was like around 1800 and let's say 1950. So on 10 January, I realized that the price may go down. So what do? I have two options. I can close my position, right? So I can close my position and book my profit. That is of 150 per share. And second option is like I want to carry the trade and I don't want to lose my profits also. So one thing is that I close my position, book my profit. Second thing is I don't want to close my position. I want to carry the trade, but I don't want to incur losses. So what I can do is I can hedge my position. So what I do is on 10th January, so on 10th January itself, I look for a TCS contract, few TCS companies future contract. Let's suppose, obviously I need to see the quantity has to be same. So luckily I find that the lot size or the contracts contract size is around 250. So this is the contract size. So it is around 250. So this I found. So I purchased one contract, and quantity is like not 250, one contract. So contract size is 250. So what I can do is I can put it here one also, one contract, but which has a size of 250. And the price is like 955. Now, why the price is 955? As we have discussed in previous class, that the contract has opportunity cost, the time value of money added, because you're not buying the underlying asset today, you got delivery after 1 month, so the seller will ask you the opportunity cost. So let's suppose it is at 955, couple of rupees more. So quite possible there is even a difference between spot and future price. So this is called spread. So the basis or spread. This is the difference between, you can say, the spot price or the future contract minus the spot price is your basis or the spread. Now, this could be a positive spread and this could be a negative spread. So if it is a contango situation where future contract is more than spot, this will be a positive spread. And if the future contract is less than a spot, that would be a negative spread. So that is a backward descent situation. Now, so let's suppose we have contract trading in the market at 955, and obviously the total value will be around 250 into lot size into the price. So that's comes to this thing. Now, what happens here is, let's say I keep it 950. I don't keep this spread here. Keep it 0, let's suppose. So here the values are same, right? Now, your position is supposed to be hedged. So what I do is, I'm not buying this thing, I am selling it. So what I am doing is, when I'm selling this contract, that means I am into a short position. So you are basically into a short position when you are selling this contract. So you're selling this contract and you have shares purchased. So look at this, you have a long position. So you have a long position in shares, right? And you have a short position in, future contract. So we have long and we have short. So both together is basically called a hedged position. So long plus short both together is an hedged position. So you have one instrument purchased, another instrument sold. So this is a hedged position. Remember, the quantity has to be same to neutralize the effect of any price gain or price loss. Now, whatever happens the next day, okay, or whatever happens in future, doesn't matter. Your profit of 150 will be locked. How? Let's see. On 20th of January, let's suppose the price actually reduced as expected to 1600. There's no so much of volatility anytime, but it goes down. Now, in this situation, what will be your profit or loss? So you initially purchased at this thing and price went to this thing. So this minus this. So basically, I'm so sorry, selling price minus the buying price. Selling price minus the buying price. So you had a loss of around 50,000 here. Now, on 20th of January, how much you will gain from future contract? So this thing is like this. So I will lock down this 19. I'm just blocking this cell. Now, so let's copy this, change the numbers. So your future contract will be also priced 1600, right? So if the spot goes to 1600 on 20th January, that is shares, your future contract will be also at 1600. So something you sold here, so you purchased here, I just put it here, long position. Okay. So you are basically selling this here. So you are buying here to offset your position, you are selling it here, and you're booking a loss of 50,000. Now in this situation, you are selling contract first and then buying contract at a lower price. Now in this situation, you are actually making profit. So you are selling at this price minus buying at this price. So you're actually incurring profit here, right? So how much profit you are getting? Now let's take the net. So this minus this. So you are, I'm so sorry. There's a plus sign already, so plus sign. So you're making around a profit of 37,500. Now this is the same thing you were making earlier, around 150 multiplied by 250. 150 multiplied by 250. They're the same amount. So even if the market went down, you are making 37,500, which you were previously making. So you actually lock down your profit. You are locking down your profit of around 37,500, no matter where the market goes. Now let's suppose you said the market went down, so I made a profit of 37,500. You locked in your profit. So this was your profit earlier, around 150 rupees per share, which you wanted to lock down. So you actually took a hedge position. So what you did is, to create an hedge, you short sold a future contract at 950. Now, if the price goes down, your future contracts gives you profit. Okay, and shares gives you losses. So losses are offsetted with the profits. So ultimately your initial profits are locked in. So that is hedging using stocks. How about if the price goes up? So let's suppose price goes to 2000. Now, in this situation, you are making a profit of 50,000 from here, and you are incurring a loss of 12,500 here. But then the net is 37,500. No matter wherever the price goes to 2100, your profit will be still 37,500. Price goes to 1000, your profit still remains 37,500. So you're locking in your profits. So that is the hedge position. So you're not incurring extra profits. Similarly, now, so here the future prices are almost same. Now, first of all, on the date of expiry, the future and spot prices will be same. Okay, why? Because there will be no opportunity cost involved. So the contract price and the share prices are same. The spread is zero. Before the expiry, there could be spread, but on the date of expiry, there will not be. Other than that, we are not, discussing right now about the spread or the spread risk. We are just assuming that the spreads are same here. Okay, so spreads are same here. Spreads are zero here. So when we purchase the shares, that time future contract were selling at the same price. Spreads are zero. We are not taking spreads in consideration for now. Okay, however, if there is some spread, positive spread, you will have some extra profit. So we'll discuss about this spread in some time, and we'll also understand about the spread risk. Now, let's understand the concept of hedging using for, in case of a currency exporter. So let's suppose there is a currency exporter, how it can help him. The hedging can help him. So let's suppose there is a guy who is an exporter, not currency exporter, who is an exporter. He exports toys. So there's an exporter, and he makes toys. So the cost is around 50, and the profit he wants is, let's suppose, 20. So he wants to sell at around 70. So selling price. Now he gets an order of around let's suppose 1,000 toys. Okay, or maybe around 1,000 toys, 10,000 toys. So let's suppose 10,000 toys. Now, so currently the USD INR price is around 70 per dollar. So for the order value will be around how much for $10,000? So 10,000 toys. So if we consider in dollars, it will be around $10,000. So that will be the value of trade or the export. So this is the quotation normally the exporter will give to importer for 10,000 toys, $10,000, because per toy $1 as the USD INR price is 70. Now, how about in future? So this order was placed, let's suppose, on 1st of January. And by, let's suppose, the delivery has to be made by 31st of March. And on 31st of March, what do we notice is USD INR price actually falls. The government do great and the price falls to 65. So that means your dollar becomes cheap because the price reduced. Now in this situation, what happens is the exporter receives how much? Exporter receives around $10,000 in USD, and when it converts, obviously he will have some losses. Why? So value in INR would come to around 10th into 65. That comes to, that has to be 0. I'll keep it numbers. So 65,000 rupees in INR. Now, so he was expecting around 70,000 value in INR, right? So he was expecting 70,000 value in INR, but he got much less. So he actually incurred a loss of 5,000. So there is a risk of currency volatility with every exporter. So an exporter can do is when they are placing this order, okay, and not placing, receiving this kind of orders, on 1st January itself, the exporter can do one thing. He can, buy or short sell. I'm so sorry. He can short sell a USD INR contract on the stock exchange or the any respective exchange. So short sell USD INR. Now how much? Let's suppose 10 lots, and lot size is lot size is around, let's suppose, 1000. In India we have 1000 lot size. So total 10,000 quantities. So he's gonna short sell, right? So because he's gonna receive $10,000, so total quantity would be around this into this much, and the price could be normally higher than the spot normally. Why? Because as per the interest rate parity, which we will learn, the foreign currency will be quoted based on the interest rate differential of these two currencies. So let's suppose it is around 71. Let's quote it 71. So you're short selling at 71. Now here the basis is around 1. The spread is 1 between the spot, which is 70, and the contract price. So you're short selling at 71. Now on the date of this thing, 31st March, you want to cover your position, buy. So you short sold here. Now you're gonna buy and close your position, offset your position. So when you're gonna buy, obviously the price is around 65. Remember, the spot and the future contract price are same on the date of expiry. Because of no opportunity cost involved, the delivery is done on the expiry date itself, so there's no difference. Now here in this case, you'll actually make a profit of 6. Why? Because you sold at 71 and you purchased at 65. So you made a profit of around this minus this, that is 6, and total quantity is around 10,000. So your total profit would be much higher. So let me copy this. So we can simply multiply 6 by 10,000. So here total value would be around 6 multiplied by how many quantity you purchased? 10,000. So around 6,000. So this 6,000 plus 65,000 both together. Okay, so total is like from spot and as and the currency future contract, you made around 71,000. So 65 plus 6,000, 71,000. In fact, 1,000, not 71,000, 710,000. So actually made 10,000 rupees more because of the spread. So if you are into a long position, you normally short sell the contract and you can hedge the position. So you're going to receive dollars. So you will be owning dollars. So you have to short sell position. Likewise, if you're an importer and you face the risk of currency, appreciation, not appreciation, dollar depreciation, and basically the dollars getting costlier, in that situation, you buy a future contract and hedge your position. So hedging in many ways reduces your risk. Okay, but sometimes hedging may incur spread risk. Now, what do you mean by spread risk? Now let's get back to previous example. Now, when we short sold this future contract, okay, there was a spread of the, let's assume there was a spread of 1955. Now, so in this situation, we are actually making some extra profit as the spread became 0 on the date of expiry. So I'll repeat again, at the time of initiation on 10th January, we see there is a spread of 5 between the spot price and the future price. So there is a spread of how much? 5. So on the date of expiry, we notice that the spot and future price become same. As we discussed, the future and spot price converges on the date of expiry and they remains the same. Otherwise, there could be an arbitrage. Okay, so because there is no opportunity cost involved on the date of expiry, because you are not making other buyer wait for any single day, you can deliver on the date of expiry. If somebody does a contract on 31st January and delivery is made on 31st January itself, there will be no difference in the price of future contract and the spot. So assuming that the share prices and the future contract price are same on the expiry, on the date of delivery, on 20th January, then you will be having extra benefit of 5 rupees. Okay, why? Because you are selling at 955 and price went to 1000. So it went around 955 rupees low, whereas it went only 950 rupees low. So you actually lost less and gained more. So in this situation, okay, in this situation, you make some extra profit. So previously your profit was 37,500, now you made 38,750. So why extra? Because you gained 5 rupees profit extra because of a positive spread here. So 5 into lot size. So 1250 you made extra. So 1250 plus 37,500, okay, is 38,750. So you made this extra because of the spread. Now remember what happens if on the date of expiry, due to any reason, there are a lot of reasons. There could be interest rate changes, there could be some mismatch due to liquidity or anything. If this spread increases instead of reducing, so it was 1000, let's suppose it goes to 1110. So the spread increases. Now in this situation, you will see you, instead of having extra profit, you lost some amount. So previously the profit was like around 37,500. Now you are having less profit. Now keeping it more simple, let's recalibrate it with new numbers. Let's suppose you purchased at 1000. Okay, so you purchased at 19,050 only on 10 January. Okay, and just remove this thing. So you purchased on 19,050, price remains 1950, and price remains 1950. Okay, on the date of 1st January. So when the price goes down, you have a loss. I keep it like 950. I'm sorry. Now look at here. So let's rearrange the numbers. You purchase share at 1950. Total value is 40. How much is this? 487,500. And on 20th January, you sold at 1000. When the price goes down, you incur this much of losses. So you purchased at 1950, you sell at 1000, you have loss. You sold at 1950, you purchased at 1000, you have profit. Now the profit and loss are 0. Now how about there is a spread, 955. Now you make a profit of 250. Why? Because on the date of expiry, the prices are same. right? Because there's initially spread of 5. Now, if the spread is, let's say, 10, you make even more profit because on the date of expiry, it is less. Now, if you want to reduce the quantity to keep it more simple, let's say reduce the quantity to 10, so it is easier for you to calculate. Now, so you are buying at 1950, total quantity 19,500, and selling the same contract at 1,000. So your 10,000 is your selling, so net 9,500 you lost. And here you sold it 1960 because the 10 rupees difference, and total value is 19,600. You are buying at 1,000, so you're making a profit of 9,600. So you are making a profit of 100. Why? Because there's a spread of 10. If there is no spread, you don't have any problem. You have zero profit. So let's suppose there was some spread, 10. But on the date of expiry, instead of a spread reducing to 0, so we look at here, the spread is 0 right now, 1,000, 1,000, the spot is 1,000 and future is 1,000. So there is no spread in between. If the spread increases, now spread increases to 10, there's still a spread of 10. Now we don't have any profit because initially there was a spread of 10. On the date of expiry, there is a spread of 10. So there is no profit loss. How about we have more spread? We have 50. Now we have a loss of 50. So if the basis or the spread, instead of reducing and a spot and future converging on the date of expiry, if does not happens, instead the spread increases, so you making a profit, you might be having losses. So that is one problem with the spread here. So that is called spread risk. If the spread increases, you may incur losses. Now, so this is hedging using stock and future, and this is about spread risk. Now let's understand one more way of hedging, that is hedging between future and future. Before we understood hedging of spot to future. Now let's understand hedging of future to future contract. Now remember, future and future contract does not basically converge on the date of expiry. They do not, because one has time value, another thing does not have time value. So how we do the future to future hedging? Very simple. Let's suppose you have 1 month future contract of TCS. Now you are buying one contract, you're buying one contract. So let's suppose you are buying one contract that is at 1800, and second contract is trading at 1820, and this is second month future contract. So 1 month future contract, let's suppose this is going to expire on 31st January, and this is going to expire on let's suppose 26th of February. So we have the same underlying asset, that is TCS shares, and we are buying 31st January contract at 1800, and on the same time we are selling TCS future of the next month. So I'm taking a short position, I'm taking a long position. So let's suppose I'm buying, I keep it here, buy, I am selling this thing here right now. So now this is called a hedged position. So remember, you're gonna sell always the costlier contract and you're gonna buy the cheaper contract. So we too have a spread of around 20. So we have a spread or basis of around 20. Now this is a positive spread, 20. So this we took on 1st January. Now remember, on 31st January, let's suppose the future contract price. So I'm not considering lots here because it'll more confuse it. In the previous example, it was confusing. So on 31st January, let's suppose the price goes to 1900. Okay, and obviously you have to sell your position to close your trade. In this situation, if you're selling, you're gonna make a profit or loss of around selling price minus the buying price of around 100. And on 31st of January, let's suppose this is also 1900. To close your position, you're gonna buy it. Now in this situation, selling price minus the buying price. Okay, so you are actually losing 80 rupees here. So your net profit and loss would be around this plus this. That is around 20, which is this spread here. Now, technically or practically, this spread will not completely exhaust. Why? Because the future contract of the current month on the date of expiry will be equal to spot. So spot and futures are equal on the date of expiry. Again, I'm repeating, spot and future, current month, future prices are equal on the date of expiry. However, why this happens? Because of the no opportunity cost. Why? I'm again explaining you in a layman language. If you buy on 1st January, the seller says that I am waiting for the entire month. I'm not selling this to somebody else. If I sell it today, I'll get some cash, I deposit into the bank, I'll make some interest. So I'm not selling because of you. So you're gonna give me the opportunity cost for the entire month, right? But if you are getting a contract, you're buying the same contract on 31st January, and the seller says, I'll deliver you at the end of day. That is not even 24 hours. So are you gonna pay any interest or any opportunity cost? Because you're not making him wait. So a contract which is expiring on 31st, okay, if you are purchasing that on 31st itself, so you got the delivery on the same day. So you are not making seller wait. So seller will not ask you anything more than the spot price. So spot and future contract has to be same. However, the second month contract will still have 1 month, uh, validity. So on 31st January, this contract will be still can be hold. You can hold this contract for till 28th of February. So hold on. I'll repeat that. Clear it. So you made this contract on 1st January. That time, 31st January contract had a validity of 1 month, and 26th February had a validity of 2 months. On 31st January, the 1 month contract expires, but the second month contract, that is 26th February, still has a validity of 26 days. So this contract will have some time value. In the beginning, it has a time value of 20. Let's suppose here spot was 1790. So it had the first month contract had a time value of 10, and the first month contract had a time value of 10 and the second month contract had a time value of 20. Right? See, 30. I'm so sorry, 30. So on the date of expiry, 31st January, the first month contract and the spot becomes same. But this second month contract will still have some time value. So let's suppose it has a time value of 10 for a month. So in this situation, the spread has reduced. And reduced to how much? Reduced to 10. So you have a profit still of 10. Right? However, if this spread reduces further, let's suppose to 1900, you have a profit of 20. If it goes backwardation, let's suppose 1890, you have even more profit. But if this spread increases, let's suppose it goes to 1920, you have zero profit, and 1930, you have losses. So if the spread increases, you have losses. If the spread reduces, okay, you have profit. So when you are hedging your one future contract with another future contract, it is for sure that on the date of expiry, both will not be equal. 1 month and 2 month contract will not be equal, because 1 month will be always equal to spot, but second month will always have some time value, so there will be some spread. So people trade on these kind of opportunities. They do try to make money on these spreads. Now this is called calendar spread. Calendar spread, why do we call it a calendar spread? Because there's a 1 month contract, there's a second month contract, there's a difference between these two. So this spread is also called as the calendar spread. People try to trade on this. Now it's not like people keep it till 21st, 31st of January. I am purchasing on 1st January. Maybe in half an hour or 2 or 3 hours, if the spread reduces, let's say 2 rupees. So on 1st January itself, the spread reduces from 1800, now it goes to like 1880. So I have a spread of reduced by 2 rupees. So a square of my position. So I am buying 1800, I sell 1800, I make 0, and I sell 1820, I buy 1818, I make 2. So I close both the positions and make 2 rupees profit. So this is called trading on spreads. So people trade. This is kind of an arbitrage, but this is not completely hedged. So this is not completely risk-free. But spot and future must converge. Okay, so you have a guarantee most of the time that you will have very limited basis risk, but here you have high basis or spread risk because of instead reducing. If it increases, let's say 1822, you will have that 2 rupees as losses. So there is a spread risk in hedging, okay, if you do not carefully hedge. Right, so hopefully you understand what is the spread risk and about the basis risk and all. Now, what are the main sources of basis risk? It says the interruption in convergence. So why there is an interruption in convergence? Now this is basically due to liquidity or market makers involved too much into the market. Okay, so this could be reason. Change in cost of carry, that means the RBI might have increased, or the Fed Reserve on the date of expiry increases the interest rate, or maybe before that they increases the interest rate, the spreads increases instead of reducing. And the basis risk is there in normally cross hedging and mismatch of expiry, and obviously liquidity mismatch. What is liquidity? Like you are buying shares which are less liquid, you cannot immediately buy or sell, or maybe shares are liquid but futures contract you don't have enough traders, so when you place to close your position there is no buyer, so in the meantime the price may move. So let's suppose you see that this is the situation 1818. and you press a buy order, but the order is not executed. So we will not have this 2 rupees profit because there's not enough buyers and sellers in the market at this time. That's called liquidity problem. So there has to be proper buyers and sellers to execute this kind of trade. So within a second, it must both the trades simultaneously close. Otherwise, there is a spread of 2, and after some time, the spread is gone. So it also, let's say, reduces by 2 rupees. So it goes to, let's suppose, 798. So there is no spread anymore. Okay, so there's a spread. There's no like reduction of spread. There's no reduction of spread. So there has to be enough liquidity so that you can offset your trade immediately, and there is no spread risk. So liquidity could be a problem where you want to place your order, but there is no buyer and you cannot offset your trade. Now, what is hedge ratio? That's called optimal hedge ratio. Now, it says that this concept that it's quite possible that there are not 100% correlation between shares and futures contracts prices of that particular share. So let's suppose we have TCS share, we have TCS future, but the future contract of share TCS and the TCS shares itself, they do not have 100% correlation. In this situation, we have to determine the hedge ratio. So based on the hedge ratio, we will increase or reduce the number of shares, okay, along with the contract. So how do we calculate the hedge ratio? This is basically the correlation between the spot and future contract multiplied by the standard deviation of futures and spot. Now this will give you the hedge ratio. Now let's take a practical example. Let me get any company's spot price and the future price. So let me open Yahoo Finance. Let's get the quote for shares, and let's get quote for any future contract shares and future contract. So let's say this TCS, working on TCS. So TCS, Tata Consultancy. So I want the historical data here, and I want 1 month historical data, just 1 month, or 3 months. No, 1 month, 1 month, 1 month, 1 month. So you need 3 months. Well, let's take 3 months data. This 3 months. 14th October to 2019 daily price supply, and download the data. So you have 3 months futures contract. There's a spot price of TCS. Now I want TCS future contract price. Let me see if we have here TCS. We have TCS Fab call. No, we have TCS. I need TCS Jan. Again, we have call and put. I need future contract. We have option data. How do I get the TCS? Good find TCS contract. I don't need options. I need future. This is option price. Call put. I don't need call put data. No worries. I'll get it from somebody else, somewhere else. Stock future expiring 31st January. TCS future, get data. Historical data for past 3 months. Get data. 26th of October, say. No worries, we'll match the dates. Get the data, get the data, get the data. Download the data. Now we have data for stock and we have data for contracts. So let's open. So we have this spot data and we have the future contract data. Now I want to use this close price. So we have this data here till 26th of October. The dates has to match properly, remember. So I'm taking, and it should also go like in from old historical date to new date. So I'm gonna short it because we need to get the correlation. So short oldest till newest. Expand the selection. Yeah. So we have oldest to newest. Now we have old data first. Now get back here to the TCS data. 26th of October we need. Now here we have 26th of October data. So we take this price and we copy it and we go to new book. I'm gonna paste it here. And now we also have to match one thing. It's not matching. This is 1st January. I need to match it. Otherwise, the correlation numbers will not be correct. So first 10, 10, 9, 8, 7, 4, 3, 1, 12, 7, 10, 17, 18, 12, 11, 10, 7, 6, 5, 4, 3, 2, 1. I'm missing on this data. Simply remove this row. And what year we are missing? 6th number, 5th number, 1st, 31st, 26, 29, 38, 31st. Now we are not missing on anything. Then why it is different? Okay, this is 14 January. I'm so sorry, this is extra. Now what I'll do is, like, we have to take the last close price. So this 4th one is the close price. And so I'm gonna remove all these numbers here. delete, and we have this thing, delete. Now we have this thing is the future contract, and this thing is shares. Now get the correlation and the standard deviation to get the hedge ratio. Array 1, comma, array 2. Get it. So the correlation is 98%. Obviously, there will be, because these are contracts. So contract will be highly correlated. Correlation is around 98%. Now get the standard deviation. Standard deviation for both of them. So the standard deviation is around 750, and the standard deviation is around, so simply copy the numbers, 54, and get the beta. Now standard deviation, we can take the change of the price, and then we can also calculate the standard deviation. Take the price standard deviation, or we can take the price change standard deviation. So to get the beta is like correlation multiplied by the standard deviation of stock divided by the standard deviation of the future contract, and get the beta. Now the beta is 0.97, is very high. Obviously it will be very high. So the contract can be perfectly, hedged. So now this is the hedge ratio, which means that you need to, if the beta is 1, which means the contract purchased can be equal to the number of, I should put it in another words, like if the beta is 1, that means if the shares move 1% up, the contract will also move 1% up. But if the beta is like less, let's say half, so if the share moves 1% up, the contract will move 0.5% up. So here the beta we have calculated that is a kind of a slope. It's a multiplier. So which means, if, as I told you, the beta is low, let's say half, if the contract moves 1%, share price moves 1% up, the contract will move 0.5% up. So in that situation, your position will not be properly hedged, right? So that is hedge ratio. Now let's take example. Let's say you have TCS shares worth let's take it. Let's take it. You have TCS future also. TCS future. So assume that the beta is 1. So let's assuming beta 1 is 1. Okay, so let's suppose you have a futures worth, let's say the price is 1800, and you have 100 future lots, and one lot has 250 shares. So you have TCS worth the same price, shares worth the same price. Okay, now you are buying this thing and you are selling this thing, right? And the beta is 1. So basically, beta is the multiplier. So you need to buy more or less number of shares to make it equal, the effect equal. So what you do here is, if the beta is 1, you can have same numbers of same values of shares and same values with future contract. So let's suppose there is a change of 1%. Now, how much profit you're gonna make? So you're gonna make around, I'll keep it 1% here, not above, so we can simply use that number in multiplication. So let's suppose there's a change of 1%. So this multiplied by this. So you make a profit of around 450,000. And whereas with TCS future, obviously, you're gonna lose this much. So the net effect will be around 0. So you have no profit and no losses, right? So if the price moves 1% up, the TCS future will also move 1% up, and the TCS shares will also move 1% up. So TCS share will move 1% up, and the future will follow that. It will move 1% up because the correlation is 100%. That is, I'm assuming, and the beta is 1. So we have no, risk in hedging here. So we have 0 risk in hedging, and this hedge is perfect. So this is perfectly hedged. Due to price volatility, you don't have any problem. But on the other hand, let's suppose if beta is less. So beta is around, it's not 97%. Sorry, I need to correct it. Basically, this is in numbers 1. So I should not give it percentage, So it's better. And keep it percentage also. So let's suppose this is the beta. Now, this means the future contract will move less if there is a change of 1%. So let's suppose there's a change of 1%. In that situation, if the beta is like 1, 97 point something, now what will happen? Now, if the price moves this thing, this multiplied by the price change, this moves this much, the shares, the future contract will move less. So in this situation, this is not perfectly hedged. I'm so sorry, what did I do wrong? Oh, I did wrong. I'm so sorry. So this multiplied by 1 into beta. So this will move less. So in this situation, my position is not perfectly hedged. So I will have a loss of around 11,000, and not loss, in fact, I'll have a profit of around 11,923 because the contract moves less than the spot price. But this is not a perfect hedge. How about if the price goes down? Instead of going up, price goes down 1%. Then in that situation, we will have a loss of 11,293. To save ourselves from this kind of situation, what we will do? We will simply multiply with the hedge ratio. So we will increase the number of shares, okay, and we can hedge ourselves. So what we will have is I'm so sorry, we have to reduce the number of shares to hedge our risk. So what we will do is we will simply reduce the number of shares to equate the profit and losses. So instead of buying this much number of contracts, we can have little lesser number of contracts, around this much of value. So in this situation, if there is a change of 1% in prices, you will lose this much. And TCS future will obviously gonna change by this much, so both are equal and you don't have any risks, and your portfolio is properly hedged. So idea is this: if there is this is not a perfectly correlated contract, or maybe a perfectly correlated contract, but then in that situation you will have a beta of 1, or maybe near to very 1, because let's suppose if you keep this correlation to 1, and beta is very close to 1, 99.1886. So if there is not great correlation, 100% correlation, there might be some risk involved. So we have a beta less than 1. So we have to buy lesser number of shares and more number of contracts to hedge our risk properly, right? So you got it? So this is the concept of hedge ratio. Now the same concept of hedge ratio is applied with index hedging. So there are contracts, there are shares which may not have future contract traded on the exchange. So for example, there are around 1900 stocks listed on National Stock Exchange, but there are approx 168 futures contract available. So which means remaining around 1800 stocks, they don't have futures contract traded in derivative segment. So the most of these companies can't be hedged with respective future contract of those companies. Now you have to go for a cross hedging. So most of the time this cross hedging is done with the index, and you need to get the beta of that index with the portfolio. The idea when you have to create the get the beta, you can use the same thing. You need to have the value of the portfolio, basically the correlation between portfolio price and the index price, and the standard deviation of the portfolio and the standard deviation of the index. You can get the beta, or you can use the other formulas for beta also. You can regress the price changes, or you can have the covariance between the index and the uh, portfolio return, and divided by the variance of the portfolio return, and kind of that. So just forgetting the formulas. So you have 2 3 formulas to get the beta. So beta is basically the multiplier. You need to get the beta of portfolio with the index, and then you can hedge your portfolio with the index. So that's the same thing. So the same situation I told you, we have a problem here also for the same thing. So let's suppose a trader computes the correlation coefficient between the spot and future to be 0.9, and the annual standard deviation of spot price is 0.2, and the annual standard deviation of future contract is this much. Compute the hedge ratio, which we already did by taking a live example, in fact. And it also says the hedging with a stock index future. So the number of contracts to be purchased, we can get it by beta of portfolio multiplied by the portfolio value and the value of future contract. So how do we do that? How do we hedge it with an index? Very simple. Let's suppose we have a portfolio value. Let's come back to the book 2. Let's suppose we have a portfolio. Portfolio means we have more than one shares in our account. We have a portfolio of 20 million shares. So we have a portfolio of around 20 million shares. And let's suppose this is 2 million or 20 million? 2 million. So you have a portfolio of 20 million. And the index is trading at, let's say, what index you want to use? S&P or anything else? So let's check out the S&P. S&P 500. Now this is trading at 2586. 2586 S&P is trading. So index is trading at 2586, and the contract size is, I get S&P is 250. The size of the lot is 250 for index S&P 500. So how many contracts do I need to short to hedge my position, or long to hedge my position? So already I have bought, so we have to sell the contracts. So how many contracts do I need to sell? So simple, and beta, you need to have a beta. So let's say beta is 0.80. Now beta, how do we calculate? We have already learned. We need to have the daily price of the portfolio changes and the index, and you can get the beta. Or you can simply regress the price changes of the portfolio and the price changes of the index, and you can get the beta. So how many contracts we need? Beta into the portfolio size, divided by the index into contract size. Now this is gonna give you number of contracts. So you need to short around 24.74 contracts to hedge your position. Now you cannot get 24.75. So you need to increase or reduce the numbers. So you may have to, let's say, reduce or increase the numbers here. So if you reduce your portfolio a little bit, you can get the number, or you can increase the portfolio and you can increase the numbers here. So let's suppose I increase the portfolio by 1, so 25.99, so 26 and contracts you need to sell to hedge your position. So number of contracts to be sold to hedge. So that is 29.99. That means 26 contracts you need to sell to hedge your position completely. So let's check out, does it eliminates the risk? So you want to increase it more, I put it 1 more here. It goes very less. I'm doing head and trial, otherwise you're going to multiply it. Now let's check out, how about 1% change in the portfolio value? So this into 1%, this cost to this much. Now how about 1% change in the index multiplied by this, and 1%. Multiplied with the beta. It has to be same. Hold on. This into the contract size and multiplied by this into 1. $25 contract is telling me the change of 1%. What did I do wrong? It has to be same. Portfolio value divided by the index multiplied by the contract size, right? And multiplied by the beta. It's telling me 26 contract approximately. 28.96. Because this 9 fixed number is coming wrong. Let me get it closer. Hold on, let me see. Mistake I did. So the index changes 1%. This okay, the portfolio value will reduce less. If the index changes by 1%, the portfolio value will reduce less, multiplied by the beta. Now, we can see both are same. So if the index changes by 1%, then the value will be this much. The portfolio will change by 0.8%. So we can see this is almost perfectly hedged, right? So this is about portfolio hedging. This is telling adjusting portfolio beta. What do you mean adjusting portfolio beta? It says to reduce the systematic risk of the portfolio, hedge it partially and take it to a target beta. What we can do is we can simply have the target beta minus the current beta, and we can adjust the portfolio. So we have the we need to have a target beta. Let's suppose we have a beta of right now 0.8 and we need to have a target beta of 1. Then 1 minus the target beta multiplied by the portfolio value and the contract and the index value. Okay, so we can get the number of contract for the hedging. Now this is a concept where we are trying to adjust the portfolio beta. So systematic risk is normally either reduced by adjusting the portfolio beta. So what we here do is basically we increase the number of contract or reduce the number of contract based on the adjusting the target beta. So here in this concept, let's suppose we have a target beta sum. Let's say this is 0.80 and we want to have a target beta of 1, then 1 minus 0.80. Now this will give me what? This will give me 0. Let's say 0.2. Now what this will do is basically it will not eliminate the risk. Normally target beta is like I don't want to eliminate the risk entirely. So we have a beta of 0.8 here and I want to partially hedge the position. I want to keep some systematic risk here. So my current beta is 0.8 and I want to reduce it to 0.5. Okay, in that situation, okay, this thing will work. So I don't want to eliminate the entire thing. So if I keep it 0.8, which is the beta here, then my position is completely hedged. But if I actually change it, let's say I want the target beta I want is like 0.5. So this is my So I simply want to hedge my position for only 0.3 risk. So in that situation, 0.5 minus 0.8. So the beta will remain 5 and I'll hedge my risk for 0.3 only. So my position is not completely hedged and my portfolio will have some systematic risk. But why, as a portfolio manager, I want to keep some systematic risk? Because I want to gain from that risk. So I completely hedge my portfolio, I will not gain anything because hedging will not give you any extra gain. So what I want to do is I don't want to completely hedge my portfolio. So instead of keeping the entire beta as a multiplier, I keep the target beta and multiply it and I keep my portfolio partially hedged. That is the concept of adjusting the portfolio beta. Now, rolling over the hedge. Now, rolling over the hedge is about when your contract expires. You have 1 month contract, you have 2 months contract, and you have, let's say, 3 months contract, maybe more. So if you have purchased a share on, let's suppose, for a contract which is going to expire on 31st January, and you purchase it, buy it for, let's suppose, 2000, and the contract going to expire on 31st January, and you purchased on 1st January. So what you do is on 31st January, let's suppose the price is 1950. So this is the price, and today is 31st of January, and this is the price for 31st January contract. So this is like 31st January future contract expiring. So the price is 1950. Now you have to close your position. Either you close it, otherwise exchange will settle it for cash. So they will do the marking to market for the day and profit or losses will be posted into your account. Now, on 31st January, you were like hopeful that in coming 5 days or 10-15 days, the price will increase and whatever losses you are currently incurring may be recovered. So you want to roll over your contract. So on 31st January, you decide to roll over. Now, what is rollover? So what you did is on 31st January, you sell this contract. So you have purchased this contract, you sell this contract, you have to sell it. So you have to close the position. Now what you do on 31st January is you buy next month contract expiring, let's suppose, 28th of February. So that is like rolling over your contract. So you sell the current month contract, close your position, and then you buy the next month which contract which will expire on 28th of February on 30th January itself. Okay, so that is rollover on the date of expiry. You can roll over before also. Let's say you want to roll over on 28th, so you sell current month and buy next month contract. So that is called rollover. But let's suppose you are buying next month contract, rolling over. So it may be more than the current month price. So 19, let's say 60. Now, why more than the current month price? As I told you, it can be contango. It will be valued more than the current market price of the current month contract. Next month contract may be priced more because of the more time value. It has 28 days remaining. So there will be some opportunity cost here. So this contract will be priced higher than the current month contract. So it will be priced more. Now there is a difference of 10 rupees. So this difference of 10 is called the rollover over cost, right? So whatever you have to pay extra, that is your rollover cost. So remember, you purchased this 2000, just and your losses on 31st January is 50, and if you're rolling over, you have to pay 10 rupees extra. So this now is an extra cost. Now you may have rollover benefits also. Okay, how? Why? Quite possible. Let's say if it is 1040. This will become a benefit. It will not be a cost. So normally that never happens, or that may happen most of the time in commodities, but not in stocks. In most of the time, stocks have rollover costs. In commodities, in some situation, there could be a negative spread, and you may get benefit if you are rolling over, because commodities are seasonal. So the next month contract may have lesser price due to liquidity mismatch or seasonality or anything like that. But normally in shares, I don't see there's any rollover benefit. So in my suggestion, if you really want to roll over, what you should do is you should notice when the spread between 1 month contract and the second month contract is lowest. So you have to have a notice of that. So what you do is you download 1 month future contract data and you download second month future contract data, and you see what is the difference here. I'll show you. So I downloaded the 1 month historical data here for the TCS 31st January. Now what I'll do is I'll look for next month contract data and get the data. Come on. So this is, I guess, next month data, historical data, and get the data and download it. No, I'm not getting it. Let's refresh this thing. Yeah, TCS 23rd Feb, historical data. Three months. Get the data. I download this thing. Now, many times you will see that the spreads are less. You don't have to wait till expiry to roll over your contract. So I'll take the close price from 19 January to November, 26th of October will take. There's again a problem here. No problem. 26 to December, November 30th. I have till 30th November, we have data. So let's take the 9th of November, paste it here, and then take the data point, data. This is the data here for future contract. So I'm taking 14 January till 30th of November. Get the data, put 3, paste it here. There are mismatch again. I need to take the dates and let it be. Just remove it. So we have 1 month contract data, we have second month contract data here. Insert. Now we have 1 month, this is Jan month, and this is Feb month data. Now look at the spreads here. So we have this minus this, and drag it here. Just notice what is the maximum one. So I put a minimum maximum formula here. The maximum spread is around 28.8. Now this is here. This is the maximum 20. And what is the mean or the median? Median is like, let's check up the median. Median is around 7.4. So if the spread is less than median, you can roll over. So that is good. Or if you want to take average also, you can take the average also. Few people take median, few people take average. So average comes to 6.11. So you can take any time you can roll over when the spread is, less. It's like less than 6. We can see how many times it is less than 6. We have here it is less than 6. We have here, 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 here. So many times the spread were like very low. So you can roll over here. So the rollover cost will be very less. Another one thing is, as I told you, you can do arbitrage also, not an arbitrage, in calendar spread hedging and make some profit from trading on spreads. So we have this difference here 7. So or maximum, what I do is I create spread on maximum number. So more than median. So median is around 7. I see, let's say this is 9.65. It is 2 rupees higher than the median. So I take a buy and sell position. So I short costliest one, the fab month, and I buy the current month. And now I have a spread of 9.6. As the spread reduces, let's say spread reduces to 0.7. And what I do is I close both the position. So I can make a profit around 8 something, 8.90 something. So you can make a profit from spreads also. But this is risky. This has basis risk. So we are done for today. Nothing, some questions. We have already taken a lot of questions here. In next week, we will discuss about the valuation, future contract valuation. We'll discuss about the commodity future. We will discuss about the currency futures. Okay, all 3 chapters will be covered. And also, maybe within 1 or 2 days, I'll give you a schedule of the entire class and entire session, and you can prepare accordingly. So take care. Have a great time. Hopefully you like the session and you understand everything. If you were there, not sleeping, it's late night now. Have a great time. Good night.